Hi everyone, this is Accounting Made Simple with Akim. Um, Today I'll be talking about IFRS 16 accounting for leases, but it will be leases treatment in the books of the lessor. Remember in my last video, I said I was going to separate my video into three under IFRS 16 for the books of the lessee, and also a separate one will be done for the book of the lessor, and another one which will be on the sale and lease back arrangement. So today I'll be talking about how we treat leases in the books of the lessor. So let me just do a quick recap of the origin of IFRS 16 like I did on the first video. The standard came into effect in January 2016 to replace the old IS 17, and set out the principles of recognition, measurement, disclosure, presentation, and disclosure of leases. Um, then, who are the parties to a lease contract? I talked about lessor as the party who leases its own assets, known as the right of use asset, to another party in exchange for consideration, while the lessee is the party who owns a value in the right to use the asset and pays consideration on it. So we treated how we account for leases in the book of lessee in the last video. So today we'll be talking about how we account for leases in the books of the lessor. So what the standard says, I mean IFRS 16, says that in the books of the lessor, it is important that the lessor first of all identify what the class of lease uh, that is going to be accounting for in his books, and the standard only recognize is either a finance lease or an operating lease. So what is a finance lease? So according to IFRS 16, a finance lease uh, is a lease where significantly, let me use the word significantly, or we can say it's a lease um, that occurs where uh, um, all risk and rewards incidental to ownership of the underlying assets are transferred to the lessee at the end of the lease term. So what this means is that um, the lessee benefits more. I mean, substantially more than 90%, for instance, about all risk and reward of ownership on the lease. Maybe you lease maybe aeroplane, for instance. You're able to, maybe the useful life of the aeroplane is maybe 25 years, but the lessee, having leased the aeroplane from the lessor, uh, continue to lease it for about 23 years, majorly, and also the fact that all risk, maybe in terms of insurance, in terms of major repairs and maintenance on the aeroplane, is done by the lessee, and also the fact that the lessee will continue to earn reward of ownership for that 23 years, which is substantially most of the useful life of the aeroplane. So we say that it transfers substantially all the risk and reward incidental to ownership of an underlying asset. That's what the standard says. So looking at it here, there are some conditions that the standard also talk about for a lease uh, to be seen as a finance lease. So the first of them is um, the lease transfer ownership of the underlying asset to the lessee by the end of the lease term. So what this means is that having leased a particular maybe equipment or a property for certain number of years, the lessee is able to receive ownership. I mean, in terms of the title to uh, the 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 equipment or the property at the end of the lease. So it means the lessee will own the asset at the end of the lease term. So that's what this is talking about. The next one is that lessee has the option to purchase the underlying asset at a price that is expected to be sufficiently lower than the fair value at the date of the option. So you are saying that, okay, after 10 years of leasing an equipment or a property, maybe a fair value of the property at that period in time, I mean after that 10 years, is maybe $1,000, and the option to purchase it by the lessee, the value to purchase is less than that $1,000. Let's say $500. You understand? For instance, it means that that exercise price of the option is lower than the fair value. At that date, the option becomes exercisable, and also it is certain, it is reasonably certain from the inception of having that arrangement that the option will be exercised. That is, that it is certain that the lessee will exercise that option of buying it at that $500, which is even lower than the fair value at the end of the lease. So in that case, we see it as a finance lease. So the next one talks about the lease term is for the major part of the economic life of the underlying asset, even if it's the title is not transferred. Okay, like I was talking about aeroplane, for instance, having a maybe economic life is 25 years, and the lessee has leased the aeroplane for 23 years or 24 years. That is huge. That is significant in the economic life of the asset. That lease will have to be classified as a finance lease. Also, at the inception date, the present value of the lease payment amounts to at least substantially all of the fair value of the underlying asset. Okay, so you are saying that, okay, at inception, the amount that we calculate as the present value from now is substantially at least minimum of the fair value. So if the fair value is $5,000 and you calculate the present value as of today, and it's at least that $5,000, then means we have to classify it as a finance lease. And with the last one, but not the least, is the underlying asset is of specialized nature that only the lessee can use it without major modifications. So this is pretty clear. So those are the conditions that has to be satisfied for a lease to be seen as a finance lease. So let's talk about initial recognition and subsequent measurement of a lease or finance lease. I mean a finance lease now, because we are not talking about operating lease at the moment. So the standard says that when we have finally ascertained that the lease in question is a finance lease, that the underlying asset present in the books at that point in time that we intend to lease out should be derecognized. Like you have a property, plant and equipment, and you've been depreciating that asset over a period of time, and you decide to lease that property, plant and equipment to the lessee for a consideration, and you ascertain that it's a finance lease. At that point in time, all the property, plant and equipment should be derecognized in the books, while a lease receivable will be recognized. What is that lease receivable that the standard is talking about? It says that the lease receivable will be equal to the net investment in the lease. Don't worry, I understand that, oh, sometimes when you say net investment, you say, oh, what is the meaning of net investment in the lease? So I have gone further to explain net investment in the lease by saying, forget about this present value for now. Look at this. It says minimum lease payment receivable on the lease. That is, when you lease a property, plant and equipment to a third party, you expect to receive some payment, a periodic payment over a period of time. Maybe every year you are receiving maybe $5,000 on the asset as lease rental. That's minimum. Those are the minimum lease payments for those number of years that you want to lease the property for, plus the unguaranteed residual value. So this unguaranteed residual value, we say it's unguaranteed because that value might exist or might not exist. And for me, I would say, okay, for instance, we lease a vehicle, for instance, for a period of 4 years. And at the end of 4 years, we all know that a vehicle would depreciate significantly in value because of the usage over a period of time. So it might become a scrap value at the end of the lease. So that scrap value that flows to the lessor at the end of the um, lease term is called the unguaranteed residual value. So let's now put the word present value at the back of it. When you now say we have this continuous payment, I mean periodic payment that flows to the lessor plus the unguaranteed residual value, what we now need to do is now to discount it back to the present. We did something similar under the books of the lessee, that we had to discount the payment that the lessee will make on that asset, underlying asset. So it's the same thing that we have to do here. So it's just that this is on the part of the lessor, and whatever this investment we're talking about, it will be a lease receivable, unlike what we have as a lease liability in the books of the lessee. So subsequent measurement will be that the carrying amount of the lease receivable will be adjusted by the interest income, because that interest income will continue to add to the lease receivable, and it will increase it over a period of time, as well as a cash receipt in the form of periodic payments. When we now continue to receive payment, that value will go down. That is what this means. So this is the subsequent measurement. So let's look at example I have below. um Let me insert more pages, more rows, sorry. So here we have a solution to the question. So let's look at the question. The question says XYZ Limited leases a freehold building to a third party on a 3-year finance lease. It was already identified, so there are no conditions to be met here. The questions already mentioned it that is a 3-year finance lease from 1 January 2023. So it means the lease commencement date, like I used to mention, that date is really important in accounting, so we need to take note of that. So lease commencement date is what? 1 January 2023. So tenure of lease is 3 years. So the question now says XYZ Limited is expected to receive rentals of $15,000 annually from the lease. That is from the lessee. That will be from the lessee. Let's see. At the beginning of each year. So annual rental will be 15,000. Yeah, 15,000. And the implicit rate of interest rate is 10%. Yeah. At the end of the lease term, the residual value of the building is $3,000. That is the residual value, the unguaranteed residual value that we have. Residual value is $3,000. Show how this will be accounted for in the books of the lessor. So we have all the parameters that we need to do. So just like what we did before, we need to have what we call amortization table. Amortization table. We did the same thing under the books of the lessee. So we have the years, we have opening lease receivable. the other one we said opening lease liability. So this one's the lease receivable. Um, look at the question very well. If you look at this question, it's different from what we did in the books of the lessee, because the annual rental year says that it will be received at the beginning of each year. So on the last one, the annual rental, I mean on the last example we did under the lessee's book, is received at the end of the year. So we need to be careful with this statement, beginning and end. So if it's at the end of the year, it means interest must have accrued on it. If it's at the beginning of the year, it means we apply interest on the opening balance. You understand? So at the beginning of the year, we apply interest on the opening balance. At the end of the year, we apply interest after the payment. You understand what I mean? So the payment will have been made at the beginning. So when the payment is made on the opening balance, then we now apply in, because the payment is made at the beginning of the year. So it means the interest that we apply on the differential between the opening balance and the payment that already made at the beginning of the year. But the last example I did says that amount will be received at the end of the year. I mean, will be paid at the end of the year, which means that I will apply interest on only the opening balance. So so let me just put that here: interest income, then payment, no, receipt. Let me use the word receipt. Then closing this receivable. Oh, so let me wrap this. Okay, so yes, so if it says we make the payment will be received at the beginning of this year, so what we need to note is that we start from year 0, because at the beginning means before year 1 starts. I mean, before the lease payment in year 1 starts, so the payment will be made at the beginning. So that's why we're starting from year 0, 1, 2, and 3, which is the 3 years. So what is a lease receivable? So that is what we don't know, and we say that how do we calculate our lease receivable? Go back to what the standard says, that the net investment in the lease is equal to the present value of the minimum lease payment. So that is the lease receivable from the beginning plus the unguaranteed residual value. So that's the lease. So we do the present value of this minimum lease payment, just like what we did. So how do we do that? We have years. We have years 0, 1, 2, 3, and what are the receipts? I mean receivables. 15,000 per annum. And don't forget that 15,000 is only received 3 times. So the last year that we now have, which is we have the first 3 years 15,000 receivable, then the last year will be the residual value, I mean the scrap value that was given in the question. So let me copy down sorry, let me copy down here. So remember the formula is 1 over 1 plus 10%, then raised to power 0 here, 1, 2, 3, just like what we used to have under our net present value when we are considering investment. So the last one will be this, yeah. So what will be the present value? That will be the net investment at the inception, which is for the lease. So that will be the 43,287. So that amount is the opening value. And like I did when I was talking about the books of the lessee, so I would like to also have my journal entries here how we represent it in the books of the lessor. Yeah. So JV1. And before I do that, so what we are receiving is first year is 15,000, second year 15,000, there 15,000, and the last one is $3,000. Don't forget the question says, unlike what we have under the example I did for the books of the lessee, this one says that the payment is made at the beginning. I mean, the lease rental is received at the beginning of each year. So when you receive lease rental, it means the interest that you apply will be on the net amount, not on the full amount. Because if you look at what we did earlier on the last example under the books of the lessee, we applied it on the opening balance because the payment is made at the end. You understand? But here the payment is received at the beginning of the year. So for us now, we have equal to, put it in brackets, this value minus the 15,000 which already received at the beginning of the year. You understand? Times 10%. So what we now have as a closing balance will now be this plus the interest income minus the payment that we receive on it. So that's 31,115 will be the opening balance in year one. Then we continue that way down to year 3. Also this one down here. Then we now apply the interest income. Sorry. Yeah. So because the third year will not apply the interest income anymore, because we have applied it to the last value, which is the residual value that will be received. So here the first thing to note is that which account are we debiting here? We have what we call lease receivable, which is lease receivable at 1/1/23, that is 1st of January 2023. That amount of 43,287 will be debited here, while we credit disposal account on PPE, because that amount will be used to recognize to derecognize that value in the books. So that same amount will be here. Then JV2, we have the interest income that we charge. I mean that we charge the lessee that has come to the lessor. So that interest income will go to P and L account. So that interest income will be credited with that value and will be debited to lease receivable. Lease receivable. And the next journal will be JV3, which will be the payment that we receive. So when you receive payment, you debit bank for 15,000 and we credit lease receivable for that 15,000. So that's the treatment for the first year, and we'll continue that same treatment till the end of year 3. And don't also forget that at the end of year 1, what will be sitting as lease receivable in the books, if you look at it, we have debited lease receivable here, we have debited this interest income on it, adding it to it, just like what we have in this amortization table here, and we have reduced it by the 15,000 that we receive, $15,000 that we receive, and this value of 31,115.70 will be the lease receivable as at 31st of December 2023, which is the remeasured value, just like what we said here, that the remeasured value, I mean subsequent measurement on the lease receivable amount, will be the carrying amount of the lease less add interest income here, then less cash received in the form of agreed periodic payments. So that is how um, we account for leases, I mean finance lease, in the books of the lessor. So for the operating lease, the standard says that if we have ascertained that the lease is not a finance lease, you understand, a finance lease is when you transfer risk and reward of ownership to the lessee at the end of the term of the lease. But in this case, that has not happened. It means that it is an operating lease, and in this instance, it's very, very straightforward. We continue to recognize the asset in the books in line with IES 16 property, plant, and equipment, and the lease rental that we receive on that arrangement will be recognized in our profit and loss account as lease income on a straight line basis. You understand? It's say straightforward. So as compared to what we have in the finance list, which we have to do a present value of that amount, but here we don't do that. We continue to recognize, we don't de-recognize the asset continue to stay in the books, but the lease rental would be recognized in the income statement on a straight line basis. Thank you so much for your time.